My electric bill is how much? Ugh. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that is my sidekick who doesn't seem to be able to turn off the lights when he leaves the room, Terrence. We're here to put the fun in accounting fundamentals. So today we want to talk about current liabilities. So what is a current liability? It's an amount that's due that we will be paying within a year or less, or an operating cycle for a business, which is usually a year. So some examples of current liabilities would be things like accounts payable, where our electric bill would live. See, there's method to my madness. Another example would be salaries payable. It's going to be paid within a short period of time. So if there are current liabilities, that must mean that there are also non-current liabilities. And of course there are. So a non-current liability, we usually would call a long-term liability. It's a liability that is due within a period of time that is longer than a year or an operating cycle. So a couple of examples of long-term liabilities would be a note payable. For example, if you buy a vehicle and you're going to pay for it over a period of 5 years, or mortgage payable. Now, why would we want to separate our current liabilities and our long-term liabilities? Well, our current liabilities are paid for with our current assets. And I will link the video for current assets in the description so you can check that out as well. So if we separate out our current liabilities and our current assets on our balance sheet, then we have a really good picture of whether we can afford to pay our bills, which is kind of an important point to know, right? So if we look now at a categorized balance sheet, we've added some details to it. We can see our current assets and our current liabilities very quickly, and we can look at them and say, do we have enough money to pay our bills next month? So some of the common current liability accounts that we'll see are accounts payable, salaries payable, short-term notes payable, so they would be payable within a year, interest payable, and the current portion of long-term debt. So let's take that example of a car loan that stretches out over 5 years. So the current portion of long-term debt would be 1 year of that 5-year liability. So that would be considered a current liability because it's due within that year. And I'll link the video to current portion of long-term debt in the description so you can see how we figure that. So as we start to add details, categories to our financial statements, it allows us to do some really helpful financial ratios. And those financial ratios tell us things about the health of our business. So this is the part where that accounting information that we've been gathering starts to really have meaning and help us to run the business to be more profitable or to be more solvent. And those financial ratios are extremely helpful. So let's take an example of a financial ratio that we've already done in this video. We looked at current assets and current liabilities. So if our current assets equal our current liabilities, we have $1 in current assets and $1 in current liabilities, we know that we are able to meet our short-term obligations. Now, if our current assets are $2 and our current liabilities are $1, we have twice what we need in order to pay what's due now. But if we have $1 in current assets and $2 in current liabilities, it means we have a problem. We do not have the assets to cover our liabilities. These are all things that you want to know up front. You don't want to wait and find out when it's time to write the checks. You want to know before you get to that point. And that's the power of the financial information that we're putting together and the way that we categorize it and report it, because then it becomes this useful tool for running our business. So until next time, stay balanced, my friends.